Yes, I'm trying to get the projector to work in KMAC 260, and it seems to not be recognizing the input. Do you happen to know which is input 1, 2, 3, 4, 5, 6 at the bottom? Yeah, that I tried that. Basically, it seems to. Let me see if it works because it just switched off. Okay, it came back on. Thank you. Sorry. Okay, let's get started. So I mentioned last class that I have packet 3 online, but I lied because those of you who did try, you probably noticed it hadn't been properly updated. Now it should actually be online in case you want to print off packet 3. Okay? First, I want to kind of close off this example I was doing last session. We're using Whole Foods as our company to analyze using price to sales ratios. And I showed you 2 different points in time, 2007 and 2009. 2007, Whole Foods was an outlier. Its price to sales ratio was 1.41, and its net margin was huge. Okay? So if I took the 2007 data, plugged in the numbers across the grocery stores, the regression I got in 2007, if I plugged in Whole Foods number, it looked hopelessly overvalued. Okay? Actual price to sales 1.41, predicted price to sales 0.43. 2 years later, its net margin had dropped, price to sales ratio dropped, but now if you plug in the numbers, Whole Foods comes out as undervalued. Again, this is not unusual. You see companies going from overvalued to undervalued across time. This is, I think, a pretty classic example of a company that was held up as an incredible success, got priced up, then delivered a couple of disappointments, got priced down. Okay? So right now, there is a fairly significant chance that people have overreacted to the last 2 years to the Whole Foods effect, and you see that reflect in the price to sales. Excuse me. Any questions on that example? Okay. Now, every example I've done so far, every sector regression I've ran has looked pretty good, right? R squared's 40, 45, 50%. In a way, I've set you up. I've set you up because when you try to run this regression on your sector, you might not get the same success. So to kind of close the loop, here's what I'm going to do. I'm actually going to take an example where nothing worked. Multiples are not related to fundamentals. All those variables we ran in the regression, nothing worked. Okay? And here's the example. It's an example from 10 years ago when I valued Amazon.com, and I came up with that conclusion that Amazon was significantly overvalued. Remember the DCF valuation I showed you from 2000? I also decided to take a look at the .com sector then and tried to see if there was a relationship between price to sales ratios in that sector and net profit margins in that sector at that point in time. I knew going in that I was probably not going to find much, and here's the reason. When you have a young sector, think of how you price stocks. You don't price them based on what they made last year. You price them based on what you expect them to make in the future. Here I am taking current profit margins, current price to sales ratios. I shouldn't be expecting to see a strong link. The link should really be between price to sales ratios today and expected future margins. But I decided to plow on. I said, let me take the price to sales ratios of .com companies and put them on a scatter plot against the profit margins of those .com companies. So I'm going to show you that graph first. First thing that should jump out at you with this graph is if I asked you to fit a line through these points, you can already see that there is no systematic pattern here. The numbers are all over the place. In fact, here are some interesting things. Look at how the net profit margin is denominated. Look at the x-axis. It goes from a minus 100% to 0%. What does it tell you about the sector? Out of the 50 companies in the sector, one was making money. They were all losing money, which is not surprising. Price to sales ratios were 10 times sales. These are not price earnings ratios. We're talking about 10 times sales, 20 times sales, 30 times sales that individual companies are trading in. So here's a sector where price to sales ratios are immense, but profit margins are abysmal. You say, how can that be? I know the relationship doesn't look strong, but I said, let me try a regression anyway. Let's see what it looks like. First, look at the R squared. 4%, no surprises. The R squared reflects the fact that there's very little linkage between the two. But here's an even scarier number, minus 7.54 on the net margin. How do you read that coefficient? What does that tell you? The more negative the net margin, the higher the price to sales ratio, right? So if you were writing a book on irrational exuberance, here is your exhibit 1. Look how crazy people are. The more you lose, the more they mark up the price. And some companies took this to heart. Remember, you lose 2 billion, we can lose 3. You lose 3, we can lose 4. Maybe there's a reason to what they were doing. But this, I think, might be a little too cynical. The reality is I'm trying to relate prices at which these companies are trading at in 2000 to what they made in the previous year, what they lost in the previous year. Even if we assume that investors are rational, they were not pricing stocks based on past margins. They were pricing them based on expected future margins. So I ask myself a different question. If I'm looking across .com companies, I know they all lose money. Why would I be willing to pay a higher multiple of sales for one company than another? And I came up with 3 hypotheses, and you tell me what you think of these hypotheses. The first hypothesis I came up with was the higher your revenues, the smaller the multiple has to be. In other words, it's one thing to trade at 500 times revenues when you have $1 million in revenues, but as your revenues start climbing, many of these companies were really tiny companies. The multiples we're seeing reflected that fact. So as revenues increase, I would expect the price to sales ratio to decrease. That was my first hypothesis. Second one, revenues right now are small, and if I'm buying into these companies, I want those revenues to grow fast. That's the only way these companies are going to start making money, is that $1 million in revenues becomes $1 billion, becomes $2 billion, becomes $10 billion. So here's my second hypothesis. The higher the revenue growth at a company, the higher the price to sales ratio should be. Saying, how come you're not looking at earnings growth? They're all losing money. And here's the third factor. In most young sectors filled with young companies, what happens to most of the young companies? They don't make it, right? So here's my third hypothesis. The greater the likelihood that a company will make it and survive, the higher the price to sales ratio should be. Which raises an interesting follow-up question. How do you measure that likelihood? I know it's been a long time, but think back to all those young technology companies and think about why they went out of business. Many of them did. Most of them didn't have any debt, right? So you can't talk about distress like we did for Global Crossing. They had no debt. So how come they ran out of business or went out of business? What did they run out of? They ran out of cash. In fact, analysts following this sector used to use a ratio called the cash burn ratio. Have you ever heard of this? They used to take the cash balance and divide by the EBITDA, which is a negative number. In effect, they were looking at how many months of cash you had as a company. And the more months of cash you had, the greater your chance you'd survive. So I took those 3 hypotheses and I put them into regression. So this is just across .com stocks. Here's what the regression looked like. The price to sales ratio for a .com stock in January 2000 was 30.61. That's the base. You can already see how high the multiple is. Minus 2.77 times the log of revenues. The bigger the revenues are, the lower the price to sales ratio is, which supports the first hypothesis. 6.42 times the revenue growth. So the higher the revenue growth rate, the higher the price to sales ratio. And I measured your likelihood of surviving by looking at how much cash you had as a percent of revenue. So the more cash you had, the greater your price to sales ratio. Incidentally, I could probably have taken out log of revenues because the T statistic is not significant, but I kind of left it in there just to throw the 3 hypotheses in. Remember again, the reason we do relative valuations is to answer specific questions. Is a stock undervalued or overvalued? The stock I was interested in January 2000 was Amazon. So I went in and plugged the numbers for Amazon into this regression. Log of revenue, revenue growth, cash as a percent of revenue. I came up with a predicted price to sales ratio for Amazon of 30.42. Given how other .com stocks were being priced in early 2000, that's the multiple of revenues I'd have expected Amazon to trade at. It was actually trading at 25.6 times revenues, which based on that regression would tell me they're undervalued by about 20%. But wait, This was at exactly the same time I was telling you watch my discounted cash flow model, that they're overvalued. Because remember the price was 84 and I came up with 34 and said they're overvalued. I'm saying at exactly the same time that they're undervalued. How can that be? How can you have a stock be both overvalued and undervalued at the same time? What's the difference between the two statements? Patrick. First one, when I do discounted cash flow valuation, when I say the stock is overvalued, what am I saying? I'm saying it's overvalued given its fundamentals, given its cash flows, given its growth, given its risk. When I say the stock is undervalued from this regression, I'm saying given how the market is pricing other .com stocks right now, this stock looks cheap. Remember that. Next time you see a buy recommendation on an equity research report, it is not an unalloyed buy. The analyst is not saying the stock is cheap. You know what he's saying? Given these 10 other companies I look at, this stock looks cheap. It's a very different statement. He is technically on fair ground making that claim, but he's making a very narrow claim. He's making it relative to whatever he's comparing the company to. And you know what? In hindsight, both those claims would have been right. 1 year later, what had happened to the stock price? It had dropped 85%, right? Which basically backs into my discounted cash flow valuation, but it dropped only 85%. See, what do you mean only 85%? What happened to the rest of the sector? It disappeared. So on a relative basis, you can buy the cheapest stock in a sector, but it's not going to protect you. The entire sector is overvalued because you've just made a statement relative to those other companies. I think this is the weakness of relative valuation in the broader sense. Is if you are an investor, you're not getting a statement about stocks being cheap or expensive. You're getting a statement relative to whatever else you compare that stock to. So that's the first thing you can try. And so this, I'm doing this because some of you are working in sectors with a lot of young companies, biotechnology companies. When you run your regression, no matter which multiple you pick, price earnings against growth, price to book against return equity, price to sales against margins, you're going to find that very little works. The R-squares are all awful. Don't give up. The other way you can approach this is to do what we did here. And in that sector, ask yourself the question, why would some companies be priced higher than others? In fact, let's take the biotech sector. Let's say you're looking at 33 companies, all of which are losing money. What differentiates across companies? Why do investors pay more for some biotech companies than others? What are some of the things you're going to throw into the regression? They're all working on drugs, right? Let's suppose they're all 33 young companies, all working on drugs, working their way through the FDA pipeline. First thing you're going to look at is the potential market for that drug. Not all drugs are created equal. You have blockbuster drugs and you have mini drugs. A biotechnology company working on a blockbuster drug with a potential market of 15 billion is going to have a higher price than a biotech company working on a drug that has a potential market of 3 billion. So in your regression, you might throw a potential market for the drug into the regression. Not all companies are at the same stage in the FDA approval process, right? Stage 1, stage 2, stage 3, because that affects the probability that this drug will actually see the market. You might throw that in. Open up, because in relative valuation, you're not constrained in how you think about risk and how you bring it in. You can bring in whatever concerns you in this sector into the regression. So that's the first plot. So the young companies, you can replace those current numbers with variables that you think should drive the pricing in that sector. Here's the other way you can deal with it. Biggest problem we have with the young companies is what you see on the ground right now is really not relevant, right? The revenues, the earnings, all those numbers are too small. They don't have any substance to them. So if you could somehow get substance on these numbers, you could use multiples again, right? Now, is there a way I can get some substance on these numbers? This company is a small company, right? But I could project out earnings, revenues, 5 years out, 10 years out. The second way in which you can try to deal with the problem that the current numbers are not substantial is to use forward numbers. So in the case of biotechnology companies, basically I'm saying get a projected income, get a projected revenue, 5 years out, 10 years out, and apply a multiple to it. One note of caution though, is that gives you the value in 5 years. It gives you a value in 10 years. And there is a very real chance you might not make it, right? But we've already figured out a way to deal with that. In the case of Global Crossing, when we did a conventional DCF valuation, we valued the company, and then we said, hey, you know what? There's a 77% chance I will not make it. Let me adjust the value. If you're using forward multiples, and this is what they're called, forward multiples, because you're using future earnings, remember to adjust for the likelihood that your company will not make it somewhere in this process. So when you think about young companies, you try the current numbers, it doesn't work. You can either go the route of looking up variables that you think should determine the value of the company today, which is what we did with Amazon and the .com sector. Or you can project the numbers out. And remember, we've already done a discounted cash flow evaluation. You have projected numbers there, right? If you did the high growth spreadsheet, you have revenues in year 10, year 5. You can pick whichever year you want and use it as your base as long as there's more substance to that year than the year you're looking at right now. Any questions on forward numbers? In fact, let me go back and use the global crossing valuation and do a relative valuation of global crossing. At the time that I valued global crossing, this is in 2001, it had lost $1.9 billion that year. I mean, that was the basis for my whole discounted cash flow valuation. Is I made it whole again. I made it into a healthy company again. In fact, let's assume that based on my projections, and still it's a projection, that I expect the EBITDA in 5 years for global crossing to be 1.37 billion. So I'm looking across my forecast. I'm pulling the year 5 number. I can't work with the number today. $1.9 billion loss. I'm underground already. I can't apply a multiple to it. But the 1.37 billion that I'm projecting out as EBITDA in 5 years is a number that I can work with. So I know what the projected EBITDA, or at least I've estimated what the projected EBITDA will be in 5 years. In 5 years, I'm also assuming that Global Crossing will become a healthy telecom company, right? If there are other healthy telecom companies out there today, I can look at what multiple of EBITDA those companies trade at today. So let's say it's 7.2 times EBITDA. Apply that 7.2 to the 1371. I've essentially got an estimated value for Global Crossing, assuming it becomes healthy and assuming my estimate of EBITDA is right. I'm almost home. That's my value in 5 years, right? What's the first adjustment I need to make? I need the value today, so I need to take the present value of that. Again, if you're sloppy, you can come up with a discount rate, but if you've already done a discounted cash flow valuation, you have a cost of capital you've estimated for this company. In this case, that cost of capital is 13.8%. I discounted the 9,871 in 5 years back at 13.8% to get to the value today. That's the first adjustment. It's a time value. The second adjustment, and this is something we did when we did the DCF valuation, is you look at the likelihood that Global Crossing will not make it. If I assume there's a 23% chance that they will make it and a 77% chance they will not make it, 23% of the time I'm going to get 5172. The remaining 77% of the time I have to sell the assets for distress. Notice it's not zero because I'm looking at the enterprise value, not the equity value here, so it's going to be a little different. My estimated value for Global Crossing, adjusting for distress and time value, will be 1.96. So if you go to work in sectors with distressed companies, I give you GM to value, or Ford to value. You could project the income out and give me this nice healthy number 10 years out. Apply a multiple to it. But before you use that multiple, first remember to bring it back to today, and you're going to be discounting at a really high rate because of the risk involved in GM right now, and then you have to adjust for the chance your company will not make it. So there are no easy solutions. If you left discounted cash flow valuation because you were worried about distress, and it's going to chase you around here. If you use a multiple, you still have to worry about distress and bring it into your valuation. Any questions on forward numbers, Malik? Through the bond market, exactly. Right? If you can find a bond market. If not, what are the other ways you can compute probability? If you have a rating, you can use the rating to back into a probability based on the rating. And if that doesn't work, then you really are in more serious trouble. You have to estimate some kind of statistical probability that your company will not make it and adjust the value for that probability. Okay? Yes?
So in this thing, don't we have an implicit assumption that what investors think about the sector will be the case 5 years from now?
It's a relative valuation, right? That's any time you enter that, think of this, I mean, the relative valuation door, once you enter, the question was, when we do this, are we implicitly assuming that what the market is paying for healthy companies today, which is 7.2 times EBITDA, it will continue to pay for the next 5 years? If we enter through the relative valuation door, when you enter that door, you know what you're saying, right? I trust the market to be right. Repeat that to yourself every time you use multiples and comparables. I trust the market to be right, because that's built in here. I have the same concerns, but there is no easy way to adjust for that, right?
Yeah, so what I was trying to say is this would be we can't even say whether the company is undervalued or overvalued in the current, using the current market sentiment, because what we are using is
The 7.2 is what the market is paying right now, right? That part, so today if you're doing a pure, if this were a healthy, let me take this back. Let's suppose this were a healthy telecom company making $1.37 billion today. Would you feel comfortable multiplying that by 7.2 and saying that's a fair value? Okay. So what concerns you is not the 7.2, but the fact that I'm projecting this number out and discounting it back, right? Unless you can tell me explicitly how the 7.2 is going to change over the next 5 years, it could go up, it could go down. So unless you have a specific reason for telling me, hey, it's going to be 6 times, there's no market number I can look up for 5 years from now. So either I take the number today, take it as a given, or I take the number today and figure out some adjustment to make to it. I can't think of a simple way to adjust an average EV to EBITDA over time for what I think will happen to that multiple. So absent that, might as well use the 7.2. If your worry is that 1.37 in 5 years from now is an estimate you might not make it, we are correcting for it in 2 ways. One is the time value and the other is likelihood you will not make it. But any time you do relative valuation, you're trusting the market on average to be right and kind of stay there over time. Right? Yes?
So would you say this method is safer to use for macro ranges than?
Safer than what?
Well, it's, I guess, more precise
Then what?
than using it for new
You can use this for a growth industry as well. The way it'll work there is if I took a biotech company, get projected earnings 15 years from now, apply a multiple based on a PE ratio, there the distress adjustment will be what if my drug doesn't make it, right? So I don't think it's restricted to just mature businesses, but with mature businesses it might make more sense simply because you have healthy companies out there right now that you can use to come up with that. You do need that 7.2. If you can't get that, then you're really stuck. In the case of the dot-com companies, that was the problem I ran into, is there was no mature dot-com company that I could point to and say, that's a multiple of earnings I should be trading at. Yes?
What makes you believe that the 7.2 in 5 years' time is going to change to 10? Or
Why?
Because historically it's been at 10 and now it's 10.
Oh, I see. So instead of using today's PA multiple, you're saying, why not use an average multiple? I guess you could do that. I mean, I have no problem with it. Did everybody get the point? Which is I'm using 7.2. You're saying, well, multiples go up and down, and I'm going to, just as we average and normalize things, why not just take a normalized EV to EBITDA for this sector and apply this 10 years from now? That's fine, as long as you recognize that one reason multiples change over time is interest rates change, right? So if you go to a normalized number that reflects an interest rate environment very different from this one, then all kinds of other things will have to change with it as well. But logically, there's no reason why you can't. I mean, anytime you talk about relative valuation, I can't say today's multiple is the only number, because relative valuation, it's a function of what you believe to be the right measure of that relative value.
So there's nothing against it.
No,
Obviously,
absolutely.
you're just
It's a different assumption about what you think is the right multiple to use, right? So basically, the assumption you're making is markets are wrong at points in time, but over time, the average multiple of earnings you see in this sector is a good measure of what the market should be paying. Any other questions? Yes?
When you discount this in a 5 years, so I'm trying to understand what happens to if there are negative
Cash flows for the next 5 years?
So how is it coming?
It's not in there. Did everybody get that point? Over the next 5 years, what kind of cash flows? Think like from a discounted cash flow world, this is like a terminal value, right? That's what I've estimated. And I'm ignoring cash flows in year 1, year 2, year 3, year 4, year 5. Absolutely. But if you can estimate them, guess where you are? You're in a discounted cash flow world. The reason you came up with multiples is why? Is because you don't want to go to... So in a sense, analysts who take the relative valuation route don't want to deal with the headaches and the problems. But you're right. We're probably going to overestimate value for that reason, because those negative cash flows are going to drain value, and I'm acting like they're not there. But if you open that door and say, I'm going to bring in the negative cash flows as well, you're 90% of the way towards DCF valuation. Might as well go all of the way. Right? Any other questions? So let's complete the story with price to sales ratio regressions. Again, let me remind you of the R squareds we've kind of seen so far. Price earnings ratio regression, the R squared was 28%. EV to EBITDA was 18%. Price to book, it jumped up to 68%. Price to sales, it's 62%. So you can already see that once you go from earnings to book value and revenue multiples, your chances of explaining differences across big market samples at least is much higher. Smaller samples, all bets are off, but bigger samples, you often find book value and revenue multiples of higher R squares. So in this case, if you look at the regression, there are 4 variables that I used. The beta, payout ratio, growth in earnings per share, because it's an equity multiple, and the net margin. Companion variable for price to sales, net profit margin. Look at the T statistic, 35.7. Just like ROE for price to book. So there it is. A companion variable is a variable that most explains differences on this multiple, and you can see with price to sales, that's going to be net profit margin. Any questions on price to sales ratios? We talked about we lose price earnings ratios, companies when we do PE ratios because earnings can become negative, right? With price to book, we lose companies where book value becomes negative, which can happen. Can you lose companies on price to sales? You actually lose about, I'll tell you, when I did this out of the 7,500 companies, I lost about 800. So how can revenues be negative? What companies do you lose? You lose a few biotech, but you know the companies you really lose are financial service companies. Because the definition of revenues for a financial service company is kind of murky, right? What exactly is revenue? Is it loans granted out? So actually many data services, if you look at revenues for financial service companies, banks, insurance companies report 0 as revenues. You think that makes no sense. That's the nature of the process. It's tough to define revenues. So the companies you tend to lose on revenue multiples are companies where the notion of revenue itself is kind of hazy. You can't define it. Which brings me to the final multiple. So far you notice a pattern, right? I define the multiple, I describe it, and analyze it. And this one, I'm going to define it, and then I'm going to throw a question to you without doing the algebra. Before I even show you the page on what drives this multiple, I'm going to ask you what the companion variable is. And we're actually going to establish a very simple rule that will allow you to identify the companion variable for any multiple. So we looked at price to sales, right? Market value of equity divided by revenues. And when we did that, we also said a more consistent version of this multiple would be to take enterprise value rather than market value of equity and divide that by sales. So the last multiple we're going to deal with is the EV to sales multiple. It has many of the same characteristics as price to sales. You can see the distribution, and you looked at it, it's much more spread out than price. You don't have the peak like you do in price earnings to price to book. But here's my question, and no fair peaking at the next page. Price to book, the companion variable was return on equity. Price earnings, it was growth. Price to sales, it was net margin. For enterprise value to sales, what do you think the companion variable is going to be? Operating margin. In fact, herein lies a very simple rule you can use to come up with a companion variable. If you have an equity multiple, here's all you need to do. Take net income and divide it by the denominator of your equity multiple. You'll have the companion variable for an equity multiple. You want to try? Price to book, which is market value of equity divided by book value of equity, right? You divide net income by book value of equity, what do you get? Net income divided by book value of equity is return on equity. Price to book, the companion variable is return on equity. Price to sales, market value of equity divided by sales. Divide net income by sales, you get net profit margin. You think it doesn't work with price earnings? It actually does. You take price earnings, you divide net income by net income. But you divide net income in the future by net income today, what do you get? Growth. Price earnings, companion variable is growth. Now let's try the EV ratios. EV to capital. Here's the rule. Any enterprise value multiple, take after-tax operating income, EBIT times 1 minus T, that number we start off, all DCF valuations, divide by the denominator of your multiple, you got the companion variable. EV to capital. EBIT times 1 minus T divided by book capital is return on capital. Enterprise value to capital, return on capital. EV to sales, after-tax operating income divided by sales is after-tax operating margin. So it's a very quick and easy way of jumping to that companion variable. You don't even need to do the algebra. Just think it's an equity multiple, divide net income by the denominator. If it's a firm value or an enterprise value multiple, take after-tax operating income, divide by the denominator of your multiple. You will have the companion variable. Let's confirm it. Okay? Let's start. Let me show you actually the distribution. And you can see that the distribution reflects a kind of spread you see with revenue multiples. In fact, in this graph, I've shown you the median EV to sales multiples. In every market, it's less than 1. So unlike price earnings, price to book, where you get numbers above 1, it's very unusual companies to trade above their revenues. In Japan, for instance, a typical company trades at 0.41 times revenues, whereas in emerging markets, a typical company trades at 0.9 times revenues. In fact, there's an interesting pattern here. Whenever I've shown you the 4 different groups of markets before, in every single graph that I've shown you with all 4, emerging markets have always had the lowest price earnings, the lowest price to book, the lowest EV to EBITDA, but when you get to revenue multiples, it gets flipped. Okay? Emerging market companies actually have the highest multiple of revenues. Now, revenue to the EV to sales ratios of any of the groups. Which tells you what, if you were just reading that in terms of margins, what does it tell you about after-tax operating margins in Japan versus emerging markets? After-tax operating margins in Japan must be abysmal. After-tax operating margins in emerging markets must be much healthier. Why? I don't know. Maybe there's a competition, maybe the lack of competition, maybe higher growth. Whatever the reason is, you see that reflected in those differences. Okay? So let's do the algebra and let's see if in fact after-tax operating margin pops up. I decided to take again a 2-stage model, and in a minute you're going to see why I used a 2-stage model, and I went through the algebra. The enterprise value to sales ratio for a high growth company is a function of the after-tax operating margin, there we get the confirmation, the reinvestment rate, that's the analog to the payout ratio, the cost of capital, and the growth rate. In other words, if you think about price earnings ratios, it was payout ratio, growth rate, beta, and return. So basically you see that when you convert to firm value, everything gets replaced. So cost of equity gets replaced by cost of capital, return on equity gets replaced by return on capital, net margin gets replaced by after-tax operating margin, but the equation looks exactly the same. So if you came to me with a high growth company, this is what I would do. I'd plug the numbers into this equation, say, I'll pay 5 times revenues for you, 0.5 times revenues for you, and it's pretty much going to be driven by whether you have 3% margins or 30% margins of this business. I'm going to use this equation to kind of talk about something which is a pretty timely issue right now. And to do this, I'm actually going to value a company. I'm actually going to take Coca-Cola. This was about 4 or 5 years ago. Okay? And this was a valuation I actually did for Coca-Cola's top management then. So they asked me to come into Atlanta and present a valuation. So I plugged in the numbers. Okay? And one of the things that should jump out at you is you look at that after-tax operating margin, it's astronomical. An 18.56% after-tax operating margin is almost unheard of for a large company. That high after-tax operating margin fed into a high return on capital, which in turn created a high growth rate. At the end of the process, I said, based on my numbers, I think you're worth 6.1 times revenues. 6.1 times revenues would translate into a value of about $79 billion. So I presented the valuation, and you could see the biggest reason driving, 6.1 times revenues, if you think about the median numbers you saw across the markets, is about 7 or 8 times higher than what's typical in the market. But that after-tax operating margin is also about 7 or 8 times higher than what's typical in the market. So I presented this valuation, and I get ready to walk away. And this was a mixed audience. It was marketing people, it had finance people. The marketing manager for Coke put up his hand and he said, "You've forgotten something very important." I said, "Maybe, what did I forget? Maybe a cash flow, maybe an entire business." So I was really nervous. And he said, "Sir," I said, "What have I forgotten?" He said, "You've forgotten that Coca-Cola is one of the most valuable brand names in the world." And I said, "Okay, so what do you want me to do?" He said, "Well, if you have a valuable brand name, you should be adding a premium to this estimate. You've forgotten our most significant asset." And I said, "What exactly do you want me to add?" He said, "About 30%. I said, "How do you come up with this 30%? He said, "That's what we pay as a premium when we buy brand name companies in emerging markets." I said, "Just because you do stupid things doesn't mean I have to do stupid things as well." Do you see what his rationale, though, is? You've missed it. You've done a discounted cash flow valuation. You missed the fact that we have the most valuable brand name, or potentially one of the most valuable brand names in the world. And it is, in fact, consistently ranked among the top 3 or 4 brand names every year. But let's say you are on the other side of this question. You valued a brand name company, and the marketing guy wants you to add, or it could be a finance guy. Let's not pick on the marketing guy alone. Right? Wants you to add a premium. How would you respond to that? It's already in there, right? You know what the response, the counter response to that is going to be? I don't believe you. Show me where. It's everywhere. It's in the sales, it's in the margins, it's the return on capital, it's in the growth. In fact, every input in here is impacted by the brand name. But they won't believe you until I can actually, unless you can take the 79 billion and show them how much of that 79 billion comes from the brand name, they're not going to buy into this. So here's what I tried to do. I said, okay, let's step back and think about what the value of a brand name is. The value of a brand name, and this might be a very bald way of putting it to me, is that you get to charge a higher price for exactly the same product. That, to me, is at the core of a powerful brand name, right? In fact, if you go to Europe, they rub it in your face, actually, right? You go to a European grocery store, you will actually see a manufacturer who produces a brown paper version of the product, and they'll say, this is who we are, this is what, and a brand name version. They will charge you twice as much for the brand name. And the scary thing is people will pay twice as much for the brand name product. There's some psychic effect here, a psychological effect that allows you to pay a premium. That, to me, is the core of a brand name. Or put another way, to me, brand name value shows up in pricing power. Through the pricing power, it affects your margins. Through the margins, it affects your returns on capital. Through the return on capital, it affects your value. Which actually raises an interesting follow-up, which is if I said, what will happen to the value of Coca-Cola if it lost its brand name tomorrow? Let's play a game. Let's suppose we all wake up with selective amnesia. And the only thing we don't recognize is that red can and the word Coca-Cola. This is every marketing person's nightmare, right? Let's make it come true. Brand name gone. It becomes a generic soda. So let's think about it. Let's think about what will happen to the value of Coca-Cola if that happened. And here I got lucky. I got lucky because I was able to find a company that manufactures generic sodas, and a lot of generic sodas. It's a company called COTT, C-O-T-T. It's a Canadian company that produces a huge amount of generic products, especially generic sodas. See, I've never heard of it. You go to a grocery store and you buy the grocery store brand soda. You know how they have the generic soda? Take a look at who the manufacturer is. An amazingly high percentage of those sodas are manufactured by COTT. They don't put their name on it. They put Grand Union, Pathmark, whoever. You can put whatever. You can put your own name on it if you want. They don't care. So I said, if Coca-Cola loses its brand name power tomorrow, it's going to become a generic soda manufacturer. And because I had access to COTT's financial statements, I was able to see what the margins were for COTT as opposed to margins for Coca-Cola. So here, this is not a valuation of Coca-Cola versus COTT. This is a valuation of Coca-Cola as is, and Coca-Cola with COTT's margins. In other words, I'm going to keep the scale of the company exactly the same. The headings are off here. Yeah. I'm going to keep the scale of the company is exactly the same. So in this column, you see my original valuation, the 79 billion. And then say, well, let me take the margin and replace it with a generic margin. I'm going to let you sell as many cans as you did before, but now you're no longer front and center in the grocery store. The store manager says, what's a Coca-Cola? I've never heard of you before. Go to the back of the store. Well, if you replace that 15.57 after-tax operating margin with a 5.28% after-tax, which is what COTT spends nothing on advertising, but it still has tiny margins because it gets so little per can of soda. That's all I did. I changed just the margin. You see, how much difference can that make? It has a ripple effect. And here's why it has a ripple effect. When I lower the margin, my return on capital goes down. Because after all, the return on capital is margin times turnover ratio, right? So if the same turnover ratio, but my margins are now 5%, my return on capital goes from 21% to 7%. When my return on capital goes down, my growth rate goes down. Why? Because it's the reinvestment rate times return on capital. So when I change my margins, I change my return on capital, I change my growth rate and my terminal value. Because my return on capital is much lower, I have to reinvest more to get the same growth rate. Bottom line is, when I replace that one number in the entire DCF valuation, my value goes from 79.6 billion to 15.4 billion. You want me to add a brand name premium? I just did. What's the brand name premium I've added to Coca-Cola? $64 billion, right? You don't think it's enough? Tell me why. If you think your brand is being badly used, underutilized, that's different. Eh? That's true of every asset. But if you're telling me I should be adding a premium for brand name, I've already 80% of your value comes from brand name. It's already embedded in there. So when you think about brand name and you think about building it in, look to see whether you've already built it in. Or here's another way to think about it. When a company talks about brand name power, how much brand name power it has, but you look at their pricing, you see that they have no pricing power. You know what that tells you about brand name value, right? That this company can talk all it wants about brand name value, but there is really no brand name value. I mean, part of the reason it was easy to do this for Coca-Cola is, let's face it, soda is soda. I know you're saying, oh, I know the difference between Coke and Pepsi. That's what 100 years of advertising and playing with your brain can do to you. It's just water with tons of sugar and a little secret formula. You can keep the secret formula. Let me just take the name. For a while there, Coca-Cola actually forgot this. They actually thought taste mattered, and if you change the taste. Remember that experiment 20 years ago they ran with new Coke, old Coke? A stupid experiment. When 80% of your value comes from brand name, you don't mess with it. That's why when Michael Jackson was a spokesperson for Coca-Cola for a little while, remember how quickly they yanked him off that front stage? Hey, 80% of your value comes from brand name. The last person you want to be associated with is Michael Jackson. Right? So it's a huge factor with these brand name companies because let's face it, nobody's ever figured out how to create a valuable brand name. You're saying it's advertising. There are companies that spend billions of dollars in advertising. Think of AT&T. How many AT&T ads have you seen over the last 15 years? And then ask yourself, what kind of brand name power does AT&T have? Whatever brand name power it has is reflected glory right now, right? Because it comes from having the Apple iPhone in there, and every AT&T ad, it's iPhone up in front and AT&T at the end. On the other hand, you have companies that spend nothing on advertising and end up with these huge brand names. I mean, I remember when Snapple first came on the to stores in the early 90s, came out of nowhere. So what I'm trying to say is brand name value is this very weird combination of money spent and psychological factors and being at the right place at the right time. So if it happens to you that you get that bolt of lightning that allows you to have a valuable brand name, don't mess with it. Okay? Because there are companies that have messed with brand name and have lost the bulk of the value. Apple did this, right, in the late 90s. And it was almost self-destructive. It was self-destructive because they brought this guy from Pepsi to run Apple first. The guy had never seen a computer before, I think. And then he started doing things like licensing other companies to make Apples because he thought it was all about volume. He wanted to be the next Dell, right? And in the process, he almost drove Apple's brand name towards zero. But to show you that there is, again, life after death, I mean, it's back again. It built itself back up using the iPhone and the iPod as the base. But brand names can sometimes dissipate. So when you look at brand name, that's a factor. But in the case of at least Coca-Cola, it was a relatively easy brand name to value because you could argue that any pricing differences are driven by brand name. There are no quality differences that actually work. In contrast, there are other cases where it might be more difficult to actually value brand name. In fact, let me throw 4 companies at you, all big brand name companies, and you tell me which of these companies it's going to be easiest to value brand name and which of these companies it's going to be more difficult. Okay? So basically, you're saying, can I isolate the brand name effect? Kellogg, Sony, Goldman Sachs, and Apple. Which of these companies do you think is going to be easiest to value brand name? Kellogg's, let's face it. Cornflakes is cornflakes, right? You can put as many names on it as you want, but you walk down the grocery aisle, what do you see? You see Kellogg's cornflakes, $4.29. Right next to it, you'd see the grocery store generic cornflakes, $1.50. It's pure brand name. But once you leave the Kellogg's example, the safe ground, you can see things get more difficult. You take Sony. You could argue that Sony is a valuable brand name, but to separate out how much of the pricing difference between a Sony and a Samsung is because of brand name, how much is quality differences, how much is service, makes it much more difficult. You can't attribute the entire difference to brand name. Same thing with Goldman Sachs. I mean, Apple maybe you can, right? Because you walk in, you have a particular laptop in mind. Take a look at the pricing difference, right? You could probably buy a Dell for about 40% less than you can. If you think purely in terms of computing power, you're paying 40% more for that Apple. That's a reflection of brand name power. Maybe with Apple, we can start valuing the brand name. Say, if Apple had margins like Dell, what would happen to its value as a company? But Goldman Sachs and Sony, it's going to be a lot more difficult because there are so many factors that feed into that pricing difference, and attributing it all to brand name is going to be difficult. You know why this is a timely issue right now, right? What do FASB and in the International Accounting Standards Boards want to do? They actually want companies to start putting brand name value on their balance sheets. In other words, they want accountants to come up with a number for brand name. God help us if this ever happened. Because this is opening a can of worms you don't want open. Because once you leave that safe territory of Kellogg's and Coca-Cola, you're going to see all kinds of stuff feeding into that number you see as brand name value. And once it goes in there, then you have to think about impairing it, allocating it, depreciating it. I mean, all kinds of weird. Leave well enough alone. Let's not even go down this road, because what do you gain as an investor? Will you be somehow comforted if tomorrow you woke up and you opened up Coca-Cola's 10K and they had a brand name number on their balance sheet? It's not like it gives you significant information. It actually might make your job more difficult in valuing these companies, but that's where we're going. That train has left the station. It's not going to stop. You're going to start to see things show up on the asset side of the balance sheet. Customer list, loyalty, brand name. I mean, it's only a matter of time. You look at a balance sheet, what's that, what's that, what's that? It's just like on the liability side, the asset side is going to get populated with all kinds of variables that people are going to try to put a name on. Any questions on brand name? In fact, this is part of a bigger issue, I think, which is when you do a discounted cash flow valuation especially, and you're doing it in front of an audience, mixed audience, when you're done, and you think you're done, people will start throwing things at you. Not physically, but throwing things that they were. Now, what about this? What about that? What about? Basically, what they want you to do is, now that you've come up with the value, to add 10% for this, take off 5% for that, add 15% for that. And you should resist to the best of your efforts. In fact, I try to get back to them with an ad that I used to see 20 years ago. It's an ad for ragu spaghetti sauce. You seen this ad? I don't think it's around anymore. This ad, actually, there's this guy he's about 40 years old, big time loser, goes to his mom's house for dinner every day, looks like it. So he comes in, and his mom is at the kitchen with this big pot of spaghetti sauce. It's an old Italian lady. And he comes in and he's shocked. He says, "Mom, what are you doing?" He says, "I'm making spaghetti sauce." And he's shocked because there are these bottles of ragu spaghetti sauce all over the kitchen. He says, "Mom, you always used to make it from scratch. You made it from a bottle?" To which her response should have been, "If you didn't show up every day for dinner, I'd probably make it from scratch." But then he starts listing off ingredients. He says, my control of spaghetti sauce is kind of minimal. So if I list anything that should not be in there, just knock it off. So let's start with the off. Where's the tomato? It's in there. Where's the oregano? It's in there. And as he goes on item by item, it's in there, it's in there, it's in there. And you know what? When you do a good discounted cash flow valuation, it should be like ragu spaghetti sauce. It should already be in there. Where's the brand? It's in there. Where's the quality? It's in there. Where's the comparative? It's in there. There's no garnishing allowed in this product. You can't keep adding things on top and say, "Oh, I forgot that, I forgot that." If you've forgotten that much stuff, then evaluation is kind of pointless in the first place. So when you see things like brand name, I'm not saying they don't have value, but if you've done a good valuation, it should already be embedded in your valuation. So let's do the last market regression you're going to see. So this is a regression of enterprise value to sales, and you can already see what the variables are going to be, right? Growth in revenue. Why? Because it's an enterprise value multiple. Pre-tax operating margin, and the tax rate. The reason I didn't use after tax is if I'm throwing the tax rate into the regression, there's no point putting an after-tax number in there because the pre-tax and the tax rate together. R squared of 50%, not as good as the price to sales regression. You probably noticed this. EV regressions, the enterprise value regressions, usually do a little worse than pure equity regressions. That doesn't make them worse regressions, but it's more difficult to explain differences in enterprise value multiples. Companion variable? No contest here, right? 29. In fact, tax rate's pretty close, 18. Okay? So when you see, remember that when you see that E1 base, remember to move the decimal point over. So it's not minus 1.88 t, it's actually minus 18.8. But the t statistic on pre-tax operating margin 29 clearly puts it as a dominant variable explaining enterprise value to sales ratios. So we looked at P, PREG ratios, EV to EBITDA, price to book, EV to capital, price to sales, EV to sales. By now, I hope you're bored out of your wits. You could see exactly where to go, right? If I gave you a multiple, in fact, this could be a final exam. I could concoct a multiple, give it to you and say, define it, describe it, analyze it, apply it. You should be able to do it. Again, it's the same process over and over again. With an equity multiple, go back to a dividend discount model. With a firm multiple, go back to a firm valuation model. Actually, as with the other regressions, I ran these across markets. It does really badly in emerging markets. There are too many differences in margins across markets for enterprise value to sales ratios to actually work that well. Okay? It does fairly well in Europe, not that well in Japan. Keep this in mind as you think about if you have to look at a global sample, which multiple you use will depend in large part on how well you can explain that multiple. So take a look at these regressions across markets and which ones do well across markets and which ones don't, because it's going to give you some indication as to how useful they're going to be in valuation. So at this stage, let's assume that you are one of those people. Every time I did a multiple, you went and tried this out on your company. I know none of you actually did this, but actually, maybe there are a couple of people or type A personalities. So when I did PE ratios, you valued a company with PE ratios. When I did PEG ratios, you valued a company with PEG ratios. When I did price to book, you valued a company with price to book. So at this stage in the process, you will have 7 or 8 or 9 different values for your one company. Do you see why this is going to be a problem? Are all of the multiples singing the same tune? Is it possible to use 9 different multiples and find on 5 of them that your stock is undervalued, and on 4 of them your stock is overvalued? Sure, right? So now we face a choice variable. As an investor, if you try 4 different multiples in the same company, you could get 4 different messages about whether your stock is undervalued, fairly valued, overvalued, and you have to decide what to do now. So let's do that as the last step in this process. Given that there are so many different multiples that you can pick from to value a company, how do you decide which multiple to use for your company? If you valued a company with 8 or 9 different multiples, here's the first thing you can do. You can say, I don't throw away any of the work I've ever done. Take all 9 numbers, add them up, and divide by 9. It's called the bludgeon approach. This is for people who, once they've worked on something, just hate to throw away their work. They have to use it somewhere. Don't laugh. I've seen IPO valuations where you see 5 different multiples, 5 different values, 5 numbers added up, divided by 5. You can already see it's a terrible way to approach it, but it's the first choice. The second choice is a little more nuanced. You have 9 different values from 9 different multiples. Maybe you take a weighted average of those 9 numbers, weighted by how comfortable or how precise you think each number is. For the moment, I haven't talked about how you'd come up with those weights, but you could have a weighted average. Or the third approach, and this is the approach that I think makes the most sense, is to pick one of the 9. Of course, you have to decide which one to pick. Let's take each of those choices. The bludgeon approach, promise you're taking good stuff, bad stuff, throwing it all in, dividing by 9. What you're going to get is junk. My suggestion is don't ever do this. It's a terrible way to approach relative valuation. I've actually seen people take discounted cash flow values and throw them in with relative values and average them out, which is just 2 philosophically different ways of approaching valuation thrown into one value. You can't do that. If you're going to do relative valuation, at least stick with relative valuation. So slightly more sophisticated way, let's think about taking a weighted average. As I said, you'd like the weights to reflect the precision of each number, right? You have 9 different multiples, 9 different values. You want the values that are more precise to be weighted more than the values that are less precise. And here's a way you can come up with it. If you've used regressions for each of the 9 multiples to come up with predicted values, those regressions came with R squares, right? And we already know high R squares go with much better predictions, smaller prediction ranges. You might actually use the R squares, the 9 regressions, to weight the 9 regressions. The regressions with the higher R squares will have their predictions weighted more than the regressions with lower R squares. But it's messy because R squares are not exactly numbers you can use for weighting generally. But you could try that. That could give you a sense at least as to what multiples are. Which brings me to my third choice. Pick one multiple. Which one should I pick? Well, the cynical answer is pick the one that best fits your story. You have how many weeks left to graduation? 4, something like that. You've already done your DCF valuation for your company, right? You come up with a value for your company. You found it either undervalued or overvalued, right? What will make your life easiest? A relative valuation that backs up your DCF valuation or contradicts your DCF valuation? Think of how much easier, how much nicer it reads. A DCF value tells me my stock is cheap. My relative valuation thinks the same too. Buy the stock, move on. After all, you're not actually spending any money, right? This is just a report. Who cares whether... it makes your life so much easier. I know it's a cynical way of thinking about it. You try 3 different multiples. 2 tell you your stock is overvalued. 1 tells you your stock is undervalued. Guess what? Your life becomes a lot easier if you pick the multiple that tells you the same story that your discounted cash flow valuation did. You're saying, I would never do this if this were a real valuation. Really? Let's say you're an investment bank. You're trying to sell a stock in an initial public offering. Right? You want to convince me that the stock is cheap. You've tried 5 different multiples. You got 5 different values for your stock, right? Which one are you going to pick? The one that gives you the highest value, the lowest value? You want to try to convince me that the price you set is low, right? You want to compare that price to what you tell me the value of the stock is. Guess what? If one of those multiples gives you a really high value, you're going to show this. Look, we valued it at 55. We're pricing it a bargain, $15. Look, you can get it for 15. In fact, the best way to throw somebody off their story is to put up your hand at one of these roads. Go to a road show just to be the skunk at the party. Just to make yourself a miserable human being. Right? Put a hand up and say, that's all nice with PE ratios, but did you try... First, they'll show you a sample, 12 firms and a multiple. First question you should ask them is, did you start with 12 firms? Or did you have more? They will lie. No, we had only 12 in our sample. No, I know you're lying. You had 25, you threw out 13. Could you show me the 13 you threw out? Hey, that's going to tell you a lot more about this valuation than the 12 they left in, right? You're showing me a multiple. Did you try any other multiples? At this stage, you're hoping for a truth teller who says, oh, I tried 3 and I threw out the 2. Show me the 2 that you threw out. There's a lot of information in what doesn't get shown to you. And guess what? What you're seeing is the best story that they could tell. Part of the reason in relative valuation, you always have to be skeptical about that number, because who knows how many tries went in before this particular iteration actually showed up. So one way to think about this is there's a cynical reason for pick up a multiple. Don't dispense it. So if you're on the other side of a transaction, always think about the bias. This goes back to that first session. We talked about bias and how that's going to feed into the choice of multiple. The second way you can pick a multiple is you can behave like an engineer. Engineers want numbers. None of the subjective stuff. And that's why they love statistics. There's an R squared there. Normally, if I show you 9 multiples, you have no idea which is good. Now you have R squared to go with 83% R squared. That must be the best multiple. It's almost entirely driven then by the statistics. Not a bad way to pick a multiple. But in a sense, you're then going to have to jump to whatever tune that multiple gives you. Which brings me to the final way in which you can pick a multiple. Pick the multiple that makes the most sense for the sector in which you're working. Right? You're saying, how would I know that? Put yourself in the shoes of the manager of firms in the sector. Think about what they focus on. Right? As an example, right? In retailing, you look at every profit report. They report same-store sales and profit margins, right? The fact that they focus so much on profit margins already tells you something about which multiples probably work best in that sector. What multiple goes with profit margins? Revenue multiples, right? Price to sales, EV to sales. So if you're doing a retail firm, I can see the rationale for revenue multiples. You go to financial service firms, there's almost an unhealthy obsession with return on equity. Your focus on return on equity, what multiple makes the most sense? Price to book ratios. You see banks, insurance companies, price to book ratios. You go into technology companies, growth, more growth, still more growth. Price earnings ratios. You tell me what you focus on in a sector, I can tell you what multiple makes the most sense given that focus. So that basically you're putting yourself in the shoes of saying, hey, what do managers in this sector care about? What multiple best fits that focus? In fact, when I did the 550 equity research report that I started a few sessions ago with, I said, I looked across. I also kept tabs on which multiples I saw show up most often within sectors. So here's what I found. Cyclical manufacturing, places like automobile housing. A lot of PE and relative PE based upon normalized earnings. Why? Because the earnings went up and down. You could not just take the last year's number. Growth firms, big focus on PEG ratios because at least there's this belief, misplaced though it might be, that by taking the growth into the multiple, you've taken care of differences in growth. Young growth firms with losses, a lot of revenue multiples for the obvious reason. That's the only number that's positive and you can use it. Infrastructure companies, cable, cellular, telecom, a lot of EV to EBITDA simply because depreciation is such a big charge and you invest so much money up front that EV to EBITDA seems to make sense. REITs, only sector I saw where you saw cash earnings being net income plus depreciation. Two reasons for that. One is depreciation is a huge charge in real estate firms. So your net income could be a low number, but your depreciation could add to that. And second, they don't have much in reinvestment because they're forced to kind of stay focused within that same sector. Financial services, price to book equity. Book equity in a financial service firm means a lot more than book equity anywhere else, right? Because that book equity is also used by the regulatory authorities for their capital ratios. So unlike a manufacturing firm, we can let book equity go to zero and keep going. At a financial service firm, you've got to kind of hold on to book equity. And retailing, see a lot of revenue multiples. It used to be almost entirely price to sales ratios until about 10 years ago. Increasingly, you've seen them shift to enterprise value to sales because retailers are starting to show much more differences in terms of financial leverage. So I'm not saying those are the right multiples to use, but don't be surprised if you go into a sector to see a multiple already entrenched. There's usually a good reason why it's entrenched, but sometimes that reason might have disappeared, but they're still entrenched with that multiple. Step back and say, maybe we should be using a different multiple. Malik?
Yeah, so I get a little confused when we're talking about the weighted average across multiples. I'm wondering, once you actually come up with that final multiple, what do you apply that multiple to?
No, you don't come up with a multiple. Each multiple, you come up with an estimated value per share. There's no point averaging across multiples. Right? You can't take a PE ratio, price to book, and a price sales. What you do is you take the PE ratio, you come up with an estimated value of equity per share based on the PE ratio. You take the price to book ratio, come up with an estimated value of equity. Take the enterprise value to EBITDA, come up with the estimated value for the firm, subtract our debt, add cash. Basically, you do, at the end, what you will have is 9 different values per share, right? Because you can't, multiples themselves are wildly different numbers. But those values per share are all your estimates of value per share. And the average across them will then be the value per share that you use for that company. It's a relative value per share, in contrast to the discounted cash flow, the intrinsic value per share. Okay. Any other questions? Okay. Now, as we went through each multiple, we also, in addition to looking at sectors, we looked at the overall market. And the reason I did that actually was to present that when we talk about relative valuation, we always have to specify relative to what. So I can value a software company relative to other software companies. I can value a software company relative to all technology companies. I can value a software company relative to the entire market. Will I get the same answer with all? Let's say I use the same multiple, but I do one against the sector, one against one against the industry, one against the sector, one against the entire market. I could get 3 different answers, right? And the reason we get different answers, we're asking different questions. If you have an entire sector being overpriced, you can find a stock look cheap relative to the sector, like Amazon was, but be expensive relative to the market. Let's not make this an either-or process. There's no reason why you can't do 4 relative valuations. Relative valuation against the sector, relative valuation against industry, relative valuation against the market, and an intrinsic valuation. Say, but I'll get 4 different numbers, right? Wouldn't you, if you're an investor, wouldn't you rather invest in a stock that's undervalued in all 4 measures? Because you have 4 things working in your favor then. So there's no reason, even if you're a true believer in intrinsic value, that you shouldn't be doing relative valuation on top of the intrinsic value, because in a sense it gives you 3 other ways of adjusting towards that value that might help you out in the short term, not the long term. Okay? But be open to the possibility that if you value a stock against a sector and you value it against the market, you can get 2 different answers at the same point in time with the same multiple. That happened to me about a few years ago. I was valuing Earthlink Networks, that at that time a kind of budding internet service provider. I valued using price to sales ratios against other .com companies, came out undervalued by 50%. I valued against the market, using the market regression, came out overvalued by 50%. At the same point in time, same multiple, undervalued relative to the sector, overvalued relative to the market. You know what that's telling me, right? It's telling me the entire sector is overvalued relative to the market. So I'm getting two different answers here. Which one I use depends on whether I want to go with that sector-focused view of investing or the market view of investing. So use every tool you have. Ask every question, because you want your stock to be cheap on many different dimensions, not just on a single dimension. Even if you're a believer in intrinsic value, there's nothing wrong with asking that it be undervalued on other dimensions as well. That's pretty much what I wanted to say about relative valuation. Define, check the multiple for consistency. Make sure it's estimated the same way across companies. Describe, which basically put up the histogram. Take a look at how asymmetric the distribution is, because it's going to give you a signal how dangerous it might be to talk about 2 sigmas and 3 sigmas when you're talking about an asymmetric distribution. Analyze, which basically means if you have an equity multiple, go back to a dividend discount model. If you have a firm value multiple, go back to a firm discounted cash flow model, do the algebra, set up the variables, or if you don't have the time, remember the shortcut. Equity multiples divide net income by the denominator, enterprise value multiples divide after-tax operating income by the denominator, and only then should you apply the multiple. So, yep.
Slide.
I'm sorry?
Slide.
Previous slide?
Yeah. In the question, it's the representation of the value, right?
Basically, both valuations can be right. What you're missing then is that the sector is overvalued. So the entire sector gets overvalued relative to the market. You can have a stock come in as undervalued. So in the case of Amazon in 2001, I didn't show you this regression, but I actually looked at Amazon relative to retail companies, and it went back to being overvalued. So actually there were 3 valuations I had of Amazon in 2001. A discounted cash flow valuation where it was overvalued, a relative valuation against .com companies where it looked undervalued, and a relative valuation against retail companies where it went back to being overvalued. At the same point in time, basically you see it flipping back and forth depending on how you frame the question. So if somebody asks you, is this stock cheap? Before you answer, get the frame of reference. Cheap relative to what? Relative to intrinsic value, relative to the sector, relative to the market, because your answer can be different depending on how it's framed. Okay? Last component of this particular set of lecture notes, I want to talk about valuing private companies. Okay? If you think about, yeah, go ahead.
When you present these results to the company, do you present the 3 different approaches for the results that you make, or do you choose one?
It depends on what. I don't do it. See, I'm not, when you're valuing it for a company, you're not doing it for investment purposes, right? They want to know their value because they want to understand the levers of value. Their question is, and this is something we'll come back to in the next part, next lecture notes, is not so much what's the value of my company today, but what can I do to change that value, right? So as a company, it's not so much what's the price, what's the value. It's what's the value today, and how can I make that value higher. So their focus in valuation is more understanding what are the variables that are causing me to have a low value or a high value, and how can I change those variables. If you're doing this for a portfolio manager who says, and I don't do that. If you value, should I buy the stock and value this? That's different, because there you have a very different objective, and there you might do all 4 and then drop it in their laps. Because which one they're going to put their weight on will depend on what their time horizon is. If they have a really short time horizon, they're going to go with that sector relative valuation, because that's where you're going to see the correction first. If they have a slightly longer time horizon, they're going to go with the market relative valuation, because they're more. If they have a really long time horizon, they're going to go with the intrinsic valuation. But you can't pick their time horizon for them, so you don't know what they'll end up weighting. Yes, Patrick.
My company often does analyze based on some of the parts evaluation. How is that different from
Okay. There are 2 ways to do sum of the parts. One is to do an intrinsic valuation of each part, which means that you take what you did for the what we've done for the company, and replicate it with each piece, which means you need all the information: cash flows, growth rates, return on capital, reinvestment rate, everything, which is possible internally, right? Because you have access to that data. I might not be able to do it from your company from the outside, but you can do it internally. The advantage of doing that is it's entirely possible that 3 of your businesses are value creating and 1 is value destroying. And you have to be aware of that, at least as a company, to make sure that value destroying part doesn't eat up the remaining 3. Right? The other way in which people do sum of the parts valuation is they take the 4 businesses and they apply a multiple to each one. In other words, they do a relative valuation of each one, which again is an extension of what we just did. The only difference again then is when you do a regression, then you're looking at the growth for the business rather than the growth for the company. In other words, replace what we did in terms of companies, in terms of each business, you get a relative valuation. With both approaches, though, there's one big problem, which is any company with multiple businesses has centralized costs, right? Some G&A costs. And in many of these valuations, people make one of two mistakes. They either ignore the centralized costs, in which case the sum of the parts value will always be greater than valuing the company overall because you just wipe $2 billion in costs off the table. Or they arbitrarily start allocating these costs across the businesses, in which case you undervalue some businesses and overvalue others. Okay? So the key in sum of the parts valuation is taking those centralized costs and having a sensible way of spreading those costs across multiple businesses based on what the cost would be if those businesses were independent companies. Okay? So when people talk about the sum of the parts valuation, it's not a third approach to valuation. It's either going to be discounted cash flow valuation or relative valuation done on slices of the company rather than the whole company. Last piece of this puzzle, private companies. The process of valuing private companies, again, is not that different from valuing publicly traded companies. Everything we said about publicly traded companies is going to apply there. You can either value the equity in a private business or value the entire business. But there are two big problems you have to overcome with private companies. First is there is no market value for either debt or equity. And we don't realize how much we use market information in valuation till we take it away. Okay? I'll talk about where we use market valuation in traditional valuations. The first is no market value. The second is financial statements for private companies have a lot more holes in them. If you worry about financial statements for public companies, especially with small private companies, it's amazing how much information you want which is not there or is misleading. So let's take each of those. No market value. Right? There are a couple of places where this is going to hurt you. First is any input into valuation where market value is needed to get that input, you can't do anymore. Right? For instance, when you do cost of capital, what are the weights supposed to be on debt and equity? Market value weights. You don't have them. If I ask you how risky is the stock, what do? You go look at if you ran a traditional regression of the stock against the market, you can't do that anymore. If you have options, how do we value them? We look at the market price, we value the option. You can't do that anymore. Any input variable where market price was part of that input, you're not going to be able to get for a private company. But here's the other place where not having a market value is going to hurt you. When you valued your company, most of you valued publicly traded companies, after you fed in the numbers and you came up with the value per share, what's the first thing you check? You check the market price, right, to see how close you are. And that's natural. If you get $2 and the market price is 200, you know you've missed a couple of zeros somewhere along the way. In other words, it's comforting to have something to compare it. There is something that you can say, well, am I even reasonably close? I'm not saying you'd end up at the market price, but you value a private company. You come up with a number. There's nothing to compare it to. There's no market price. There's no metric you can look at and say, am I even close? And you don't realize how much you miss it until you don't have it. So you value a private company, you come up with a number, and you have the number. I don't know whether this is right or wrong or close or not so close. So those are variables that I think get affected because you don't have market prices. So we have to somehow deal with those factors. Second issue. When we think about estimating cash flows, we take earnings, we subtract out reinvestment, we net out taxes, we come up with cash flows. With private companies, we have four problems. First is there aren't too many private companies that have been around 80 years, 100 years, 50 years, or even 20 years. Many small private companies, you'd be lucky to get 2, 3, 4 years of data. That's a problem. Second, accounting standards can vary wildly across private businesses. I had somebody in this class 3 years ago who was valuing her mother's flower business, and her mother had a very strange accounting system. There's a yellow tab. Basically, she would write little tab notes to herself, and little yellow post-it notes, and post it all over her office. She'd pull them all off and take them into the accountants. And she had a very good, in her mind, it was revenues on one wall, expenses on another, financial expenses on the third wall, but doesn't quite fit into our FASB requirements as to what goes where, right? So that's the problem. Private companies, especially small private companies, this line between the personal and the business is a very fine one, right? That business car also takes the kids back and forth from school. That cell phone that supposedly is the business cell phone is making, IMing calls and texting and doing all kinds of stuff with, nothing to do with the business. This is not unique to private businesses, incidentally, but with small private businesses, it's going to. And some private businesses, you have what I call the George Costanza effect. You've seen Seinfeld, right? Seinfeld, George Costanza worked for whom? Worked for the Yankees. What? Vandalay? I have no idea what you're talking about. He worked for the Yankees. But in all the years I've watched the Seinfeld episodes, I think there's only one episode where he actually did something for the Yankees. I think he changed their uniforms into polyester uniforms or something, created a huge fiasco. But all the rest of the time he said, what exactly does he do? And there are some private businesses you walk in and you see these people and you say, what do they do? They have the common characteristic they share is they all have the same last name as the owner. But they kind of wander in, they wander out. It seems like they get paid the salary, but you're not sure for what. You see why this is going to be a problem, right? When you see the reported income for a private business, it's not your starting point. It's not your ending point. It's actually your starting point. You have to start with the income and kind of work back and find out what the true earnings for this company are, which is a lot more work than taking FASB or 10Ks and saying, I've got the operating income, now I can run with it. So practical issues that you run into that you don't run into with publicly traded companies. Final issue with private companies. You see, let's say it's a small private company. You have an owner for the private company. The owner does not pay himself or herself a salary. Why? Because whatever profits are left in the company come to him anyway. So what's the point of paying yourself a salary and then taking what's left over? You see the consequences for you if you're trying to value this company. The owner gives you his income statement. Remember, he doesn't pay himself a salary. But does he do a lot of work around the company? He's the inventory keeper, the accountant. Basically, he is the company. And you've not put in the money. You take his stated earnings. You pay a price based on that stated earnings. You come in tomorrow to run that company. What are you going to find? You're going to be hiring 3 people to replace this guy. And once you hire those 3 people, there is no earnings left in the company. It's a big issue in valuing private companies. Is ask yourself, who's doing the work around this company? And where's the salary for their work? And the person doing the work might say, I'm the owner, I don't pay myself a salary. That's fine for your purposes, but for my purposes to value a business, I need to attach a salary to what you do to figure out what the business is actually worth. So with private company valuations, this is an issue we'll talk about. Yeah.
Maybe this is saying it another way. Couldn't they also not pay themselves salary to avoid payroll tax?
It could be. So there might be tax reasons for not doing it as well. But I think the bigger reason is the money ultimately gets to them. Especially if you've not set up a different tax status. You're going to get taxed on that whether it's treated as dividends that you take out of the company or whether you pay yourself a salary. So it might be a tax issue, but even if you did not have the tax issue, they might say, what do I care whether it's a salary or dividends? I'm going to get it out of the company anyway. But whatever the reason, we've got to go in and put in a number that reflects what it would cost us. Even if you decide to do that work yourself, replace the owner and do it all, you still have to price your time. Your time is not worth nothing, which is effectively what you're doing when you put in a salary of 0 and value the company on that basis. Here's the last thing I want to say before we end for the day. How you value a private company is going to depend in great part on why you're doing the valuation. Sounds like a stupid thing to say. But if you look at why private companies get valued, a lot of valuations are show valuations. You know what show valuations are? Owner is curious as to what the business is worth, or is interested in allocating amounts across different assets. Show valuations. As opposed to transaction valuations where you're actually valuing this business for sale. How you approach the valuation can be different depending on whether it's a show valuation or a transaction. A lot more rights on a transaction valuation because real money passes hands. The other factor that you have to think about is why are you valuing the company? Are you going to do a spin-off? Are you going to sell to who are you going to sell to? Who's the potential buyer? So next session when we start off, that's the question we're going to start off with is how do we factor in why you're doing the valuation and who you're selling the company to when you value a private company?